All right. Hi, everyone. We are live. Thank you so much for tuning in to Market Matters. My name is Katie Kuntz, and I'm a social media editor here at CNBC. I'm joined, as always, by CNBC's senior stocks correspondent, Bob Pisani. And today we're going to be answering all of your questions about the latest stock market moves. Nice to see you, Bob.
Hi, Katie. How are you?
I'm good. I'm doing well. So, lots of questions today. Let's jump right into it. First of all, what is driving this market sell-off that we're seeing in April?
Well, if you think about it, there's three major events going on, and they're all different, and they're all really important. Number one, to be blunt, the Federal Reserve and the inflation outlook is threatening the U.S. economy, perfectly bluntly. Secondly, the Ukraine war is threatening the European economy and other parts of the global economy. And third, this very big COVID shutdown in China is threatening the Chinese economy, and it's also threatening to reduce demand for global commodities like oil. And they are one of the biggest producers of commodities and consumers of commodities in the world. So think about this: three separate threats to the three biggest geographic areas, the United States, Europe, and Asia at the same time. This is an awful lot for the market to deal with. And it's one of the reasons we get these crazy gyrations. I mean, look, the S&P 500 moves 100 points in a day. I mean, that's crazy. That's an indication the market doesn't have any clue on where it's going. All it knows is the uncertainty level is extraordinarily high. As you know, that's not good for stocks. And that's why you get days like today where the market's up, but it doesn't feel like it's up much. There's kind of a zero bid in the market, so stocks are kind of rallying off their lows today, and some of the tech names are doing a little bit better, but there's not a lot of conviction in it. There's not a lot of, there may be a reduction in selling pressure, but there's not a lot of buying interest. So remember, it's a two-sided market. Somebody's got to buy and sell. But so you can get selling pressure drop off, so stocks kind of rise. But if you don't get aggressive buying, and you see this in the volume, it doesn't matter. The people who watch the market say, okay, we're up a little bit, but nobody's aggressively buying stocks as a result. That's kind of what we've got. So just think of those three things: inflation and the Fed threatening the U.S. economy, Ukraine threatening the European economy, and the China COVID lockdown threatening China economy and global commodities in general. It's an awful lot to deal with.
So, Bob, let's talk a little bit about how companies are holding up with all of this. Can you tell us how earnings season is going so far?
Well, I would say okay, but it doesn't matter that much. I know it sounds crazy because I always talk about earnings. The problem is, because of all these macro things I just talked about, the first quarter numbers are kind of not that important. Everyone wants to know what's happening in the second, but particularly third and fourth quarters. And people don't believe the numbers, the estimates, because they were based on things that happened, largely even before the Ukraine conflict. And a lot of people are concerned that the earnings numbers are going to get a lot worse if the global economy kind of suffers even more. So a lot of people don't believe some of these earnings estimates that are out there. Right now, if you look at today, all right, some of the tech companies a little bit, I'd say, better than people were afraid of. So PayPal's up. PayPal had been going down for a long time. Facebook's up. Facebook's been going down for a long time, though. Pinterest up, but same thing there. The one good thing I would say about earnings is the consumers are on fire. I mean, MasterCard had great comments, just like Visa. Basically, the consumer's doing really well. People are spending like crazy, particularly on trips. We had the Southwest CEO, the airline CEO. He said what the American CEO said: the business has never been this good. Go try buying an airline ticket. You're going to be shocked at the prices, and yet people are paying it. So that's good. The consumer's good. If you own ExxonMobil, you're going to be very happy because the earnings are going through the roof. They just, for all the oil companies, up, 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 up. They're raking in cash, but they're small. These companies are not very big. They're 3% of the S&P 500. So it's nice. Earnings estimates for energy companies are going up, but that's not going to move the dial big if you own the S&P 500. A couple other things, like I said, the airlines are doing really well. The question is largely what's happening with estimates for the second, third, and fourth quarters. And here you can see the stock market is believing that the earnings estimates are going to be coming down. So you have two problems. Number one, Jack Bogle, who used to run Vanguard, the guy who had the most influence on me, said there's three things that determine the direction of stock prices. One is an expected dividend, and the dividend's small for the S&P, 1.5%. Number two is the directions of earnings. Are they going up or are they going down? And finally, there's the market multiple. We call it the PE ratio. The multiple is just what are people willing to spend for a future stream of earnings? It's the speculative element. So this year, the decline in the S&P is almost completely due to a decline in the multiple. The forward estimate for the S&P 500 on January 1st was about 21 times. So the S&P was trading at about 21 times the estimate for earnings for the S&P 500. That's a little on the high side. Historically, it's 15, 16, 17. Now it's down to 18, 18.2, something like that. That's a decline. If you do the math here, that's quite noticeable there. That's like 12, 13, 14% decline. Interestingly, that's what the S&P is down. Earnings have been pretty steady. The estimates here are up 6, 7, 8% on the year. They've been fairly steady. But a lot of people believe, as I said, those earnings are going to come down. If that happens, there's another potential leg down to the market, because we've had a leg down because they're taking the multiple down. They're not willing to pay as much for a future stream of earnings as they used to because of uncertainty around the economy and higher interest rates, which reduces the value of those future earnings. So it's a very tricky situation right now. I would say watch what happens in the next 2 weeks. We're going to get a lot of big consumer names next week. A lot of restaurants will be reporting. It'll be very interesting to hear what they have to say. So I'd say it's still good, but tricky. And think about this. Companies, suppose you have good earnings. All right, you might go up 2%. If you disappoint in any way, you're getting killed. I mean, so there's a big downside risk, a little bit of upside risk, but a big downside risk. And that's kind of what we've been seeing for this earnings season.
Thanks, Bob. And we'll definitely be continuing to watch and see what happens there when more companies report in the coming weeks. Another question that we get a lot, is a recession coming? What do you think? What do you see?
Well, I don't. This is a tricky question. So today, again, we're getting all these questions because the GDP for the first quarter was down 1.4%, and everybody, a recession is defined as 2 consecutive quarters where GDP is negative. So now you're getting all these headlines and you're getting messages from people saying, does this mean we're entering a recession? Well, I don't know. This was a very funny GDP report. This is really more of a question for Steve Leeson, our economics reporter, but it looks to me like demand was still strong. There were some weird things in this report. So there's the trade deficit was a lot higher because of weirdness in the way the whole global economy is. But as far as I can see, the consumer is still strong. So consumer spending grew 2.7% annually in the first quarter. That's pretty good. And it was driven by services, people going out and spending things, and they're redirecting their money. Maybe they're not buying as many goods. They're not buying, dishwashers or washing machines. They're going out and spending it on what we call services. So I think the consumer right now is still pretty strong. Look, we haven't had a recession, in 13 years. That's kind of unusual, but there's no sign of it immediately. I've never seen so many people trying to front run a recession. I've been at CNBC 30 years, and it's amazing how many people want to, think they can call this, and it's not easy to call. I wouldn't worry about it right now. That's my point. Obviously, there are people in the market that are worrying about it. I think the inflation question is a little bit more of a serious question now.
Yes, you bring up inflation. You've said the consumer looks strong, but are there any signs that consumers are pushing back against these price increases that we've been seeing?
Well, not yet. I'll tell you one thing that I saw a month ago. I made a big deal about. You kind of look for all of these early warning signs, the canary and the coal mine stuff. Carvana, which sells cars, came out and said used car prices were up 30% year over year. We all knew this. But they said we're starting to see some people push back because they can't afford these higher prices. Now, that's a sign, and I made a big deal out of that. There hasn't been an awful lot of signs of pushing back since then, certainly not in airline prices or hotels or even food prices, people going out to restaurants a lot. There was a very interesting tidbit from Hershey's this morning. They sell chocolate, okay? So, there's what we call elasticity in everything. So you got a chocolate bar, it's $1. Then all of a sudden you charge $1.05. In a strong consumer, you can get away with it. But if you charge $1.25 and the economy weakens, people are going to say no. So here's what they said here. Let me just get this up here. Where is this? Oh, this is from Hershey. Elasticity is this word that they use to describe whether they can raise prices and not have people stop buying. So here's what they said. Elasticities were stronger than anticipated in the first quarter, but they're expected to moderate as consumers' buying power is pressured by inflation and fewer government benefits. Okay, so this word elasticity is a kind of fancy word. It means, okay, we're able to raise prices without crushing demand. So Hershey said, we're able to raise prices, chocolate bars we're talking about here, so far, but we're anticipating if we get more inflation, they're going to push back. If we keep doing this, because their buying power is being eroded by the high inflation. Eventually, Hershey's is saying we anticipate eventually the consumers are going to push back. So I'm not projecting anything. I'm just reading what Hershey's said. This makes a lot of sense. Like I said, you got $1 per a chocolate bar. Maybe you could charge $1.05. You start charging $1.10, $1.15. Eventually, you're going to sell less chocolate bars.
Yeah, it'll definitely be interesting to see where that line is for consumers when they start paring back more. But for now, as you said, consumers look strong. So Bob, next question that people are interested in is Elon Musk, of course, and his deal to buy Twitter. What does that mean for investors?
I don't think it means an awful lot for investors. I've said this many times. I think Elon Musk is one of the great geniuses of the 21st century. I think he is the Edison, Thomas Alva Edison of his day. A lot of people talked about going back to the moon. Musk talked about going to Mars and built a big rocket to do it. A lot of people talked about really reinventing the electric car industry and completely redesigning electric cars. He did it. A lot of people talked about finding a way to store solar energy in a battery that would last, and you could do it. He did it. Those are big problems, and he's figuring them out. So I think very highly of him. On the other hand, there are people like me who are fanatic supporters of his that are somewhat baffled by how he gets into these little rabbit holes like Twitter, which for most of us who want him to focus on the big things because he's a genius, kind of are disappointed in, like, why are you spending your time with this? And I think the way to sort of understanding it is, to him, it's extremely important. Why? Because he doesn't spend any money on advertising. It's remarkable. Do you ever see like big Tesla ads or you don't? He basically uses Twitter as an advertising platform, and he has a gigantic megaphone. Is Twitter really important to the world? No. I'll tell you who it's important for. Journalists like me, people, big public opinion people, makers like Elon Musk, and the people who want to follow him. Most of the rest of the world, they're doing other things. They're on Pinterest. They're looking at other social media platforms like Facebook or TikTok. They're not that worried about Twitter. But to him and the people who follow him, it's very important. So in a certain way, if you try to think like he thinks, I need a platform to get my ideas out and influence people, and I can use Twitter to do that, then that's better. With that said, for those of us who want to support him, we want him to think about the big things and not get so concerned about his personal marketing. So I understand why he's concerned about it and why he wants to play around with it. I wish he'd spend a little more time on those big global issues where he's going to change the world.
So, Bob, our next question is about one stock in particular, company Teladoc. So that's a big Cathie Wood holding, down 48%. What happened there?
I'm going to try to make a very broad statement here. Usually I don't. You saw what happened with Netflix? Netflix was one story, peak streaming. People are kind of peaked out on streaming in general. I thought about this when I saw the Netflix stuff, and I said, I actually don't know how many streaming services I have. My wife's a huge movie fan, big, watch old movies, you know. And we have streaming movie services. I can't even keep track of them. I literally spend a lot of money on this. And I thought about it when I saw it. I went to my wife. I said, we should add up how much we're spending, because all I know is we've got an expensive habit to watching old movies, and they're charging us a bunch of money. And I think a lot of people are doing exactly what I'm doing, starting to say, this is really kind of stupid. How much are we doing here? How many times we actually use this service, and we're spending $8 a month on it, and it adds up. You get 7 of these services, it adds up. And I think a lot of people are doing that. So that was sort of peak streaming. I think you're going to see a lot of things about peak podcasts. How many podcasts can the world listen to? There's one for everybody on the planet, it seems like. Or what does this mean with Teladoc? Teladoc is an online health services. They provide mental health and chronic care, largely, what we're doing now, online. And I think for a lot of people, there's sort of a peak online presence for a lot of people. Just like, Zoom, for example. How many more people are there out there who are going to sign up for these services? So they slashed their guidance and they took a big write down. There is a lot of competition in the online mental health space. Believe it or not, there's a lot of companies that have gone into this already, and chronic care. And one of the things they said is it's getting a lot more expensive to acquire new customers. They have the ad spend, the amount of how much they have to spend to get a new client has gone up rather dramatically as well. That's a sign, resistance out there. And I think, to tie this back to Netflix, there's a broader question. What's the role of virtual care in the post-pandemic world? That's a specific question. But is it too, like streaming in general, starting to look a little saturated? So this concept of saturation can apply across many different platforms. It can go all the way from Netflix to podcasts to streaming music services, and even just online services like Teladoc, for example. So there's my big picture attempt to tie it all together. I don't know if that was successful or not, but you have to look at these things from to a certain extent, from a 30,000 foot point of view. And I think this peak concept is very real.
Yeah, I definitely think that the Netflix streaming example is very relatable for a lot of people, I'm sure. So our next question, we kind of teased this a little bit last time we talked, Bob, but you were at an ETF conference down in Miami, and you had some big interviews with Cathie Wood and Jeff Gundlach. How was the conference, and what did you learn?
Well, I loved it. First off, it was the first time I had been to a big conference, anybody, in almost 2.5 years. So it was, 2,000 people in Miami Beach. I'll tell you something as a sociologist that was interesting. There was a lot of awkward little moments at some of the cocktail parties where people were just like looking around. Half a dozen people said, I haven't been around this many people in a long time, and it's a little strange making small talk with people. So human beings kind of got used to being alone, and we're social animals. You learn how to interact with each other and talk. And when you haven't actually been around anybody talking for 2.5 years, you say, gee, this is kind of weird being around all these people. And from a sociological point of view, it was interesting to see some of these awkward silences. But beyond that, it was very interesting to see, mostly these are registered independent advisors. These are financial advisors getting together because they're using ETFs in their portfolios for their clients. And they get together, and it's very interesting. The industry is growing. More money keeps going into this ETF space and out of mutual funds because they're cheaper. But these RIAs, they're just scared shitless, frankly, because their clients, most of these people have not only been around less than 10 years. A lot of them used to work for Morgan Stanley. They left and they set up their own shop because it's easier. You have your own money, you have your own clients. It's cheaper to use ETFs. And so they've got their clients in 60% stocks, 40% bonds. They're all ETFs that they got. Well, it doesn't matter. For the first time in 12 years, the stock market's down and the bond market's down, and their clients are opening up their statements saying, what the hell? And they're under a lot of pressure, particularly on bond funds. So everyone was listening to Jeff Gundlach very carefully because he had ideas about bond funds, and the 60-40 stocks bonds idea is kind of out the window. Very hard to argue for that kind of division between stocks and bonds when bonds are going to go nowhere but down, yields are going to go up, likely for the next year at least. So there was a lot of interesting debate about that. And remember, these RIAs, maybe you have one at home, or maybe you are one, are sitting there saying, what do I do with this? And they're sort of like active managers. They're not hedge fund managers, but they kind of are in a way that they give advice to their clients, and they have to decide, should I tactically start moving stuff around? And so a lot of people had to face some very difficult decisions overall. So I think that was really the most interesting thing about that the investment community very worried about the bond situation.
Well, it was great seeing you get back down there and out into the conference, again.
The best thing, just say something quick. I spent some time with Kathy Wood. She's just a wonderful woman and a brilliant intellect. She has taken a lot of hits, and some of them very nasty and personal, because she's down, more than 50% year over year. That's tough. What's remarkable is the amount of the loyalty to her. Normally, if you have a fund and it's down 50%, people leave, they get out. But what we call the flow in the ETF, the shares outstanding are about the same as they were a year ago. I mean, think about that, down 50%, and yet there's not been mass selling of her fund. People who were there, by and large, still trying to hold on. Doesn't mean there's not churn, but there's not so much selling pressure that they have to sell the shares in the fund to meet the redemptions. That's pretty amazing. I mean, and I mentioned this to her when we were doing the interview, and she said, yes, thank you to everybody in the audience. She said she's very grateful that she knows she has a loyal audience. But it's very tough right now for her because it's not about disruptive innovation. That's what she's into. Her companies, she says the revenues are going up 50% a year, even this year. And that's true. But it's not about revenues. In this environment, it's about who's making money, who's not. A lot of her companies don't. They may in the future, but they don't now. That is much lower value when interest rates are going up and when the economy may be slowing. So she's got a problem. And her argument now is, you're going to stick with me for 4 or 5 years, you're going to make money. But in the short term, you can see how painful it is.
Yeah,
Teladoc,
exactly.
for example, is her third biggest holding.
But you're right. She does have a very loyal following. So we'll see if they stick with that. So just to wrap up here, Bob, I kind of want to tie everything together. What is the best kind of investment to have in this current market?
Well, I go back to the fundamentals and listen to the people who come on our air. Listen to the investment professionals. Yes, there's a small group of you I know that like to day trade and like to go in and out of the market. We all know this, and we have shows for this. But listen to any of the long-term people who come on our air, who will tell you that generally market timing does not work. You cannot figure out when you need to go in and when you need to go out. If you try doing this consistently, you generally will lose money. This is very well documented. People cannot consistently try to time the market long term. I don't want to hear about your one trade that made money in January. I'm talking about try doing it for years, day in and day out. Can't make money consistently. That's why the investment professionals talk about long-term investing that is suitable for your age and your risk tolerance. If you're 30 years old, you should have a very high risk tolerance because you're going to live for 70 more years. And what happens this year, trust me, is not going to matter 10 years from now. What you should be doing is consistently putting money in on a regular basis and building the portfolio. I don't have any problem. I say this to my nieces and nephews. If you're 30, they're 30, and you can buy the S&P 500 and just hold it and don't worry about it right now. If you think you're a genius, go ahead, take 10% of your money and go ahead, trade Teladoc. I think you're going to lose money long term, but if you want to, go ahead. Even Jack Bogle recognized that. People want to do it, go ahead. But don't be foolish. And don't think you know more than the market does. You don't. Believe me, you don't. If there's anything I've learned 32 years watching the stock market at CNBC, you're not smarter than the stock market. So consistent buy and hold really matters. And if you think you can pull out and know when you can go back in again, you can't. We all know, I'll show you studies, hundreds of them, where there are 10 days in the year that matter, and you don't know what 10 days they are. And if you're not in on that, it doesn't matter 10, you can pick 15 days. You're going to have a very, very low return compared to your benchmark, compared to the S&P 500. So you can't guess the up days or down days. You can't do market timing very successfully on a long-term basis. This is what all the investment professionals on our air tell you about. And the answer to it is believe in the U.S. economy, believe in capitalism, and believe that over time the stock market goes up. Not every year. It's possible this year we'll have a down year. It's possible, for sure. That would be one of the first down years in the last 12 or 13 years. Extraordinary run we've had. So if we have a few years where the returns are below normal, and that is highly likely, given we had 12 years where they're way above normal, don't be too surprised. Just don't try to fool yourself into thinking that you can time the markets. You can't.
Well, that's great advice, Bob. And I know our audience always is interested in hearing your advice on this. So thank you for sharing with everyone. Thank you to everyone for sending in your questions. As always, feel free to leave a comment if you have any questions you want us to address next time. But thank you, Bob.
Thank you, Katie, and everybody. Thank you. These were great questions. Guys are always on top of it. You always ask the right questions.
For sure. So we'll see everyone again in a couple of weeks.
Thanks.